Hey everybody, Preston Bryn here with our Trader User Group Weekly Roundup. This is for the trading week ending June 3rd, 2016. What I've got on the screen is the E-mini S&P 500 futures, and what an interesting end to the week we had. The jobs numbers came out. Only 38,000 jobs. I think that was one of the worst or the biggest miss in several years with the jobs number. And we saw a pretty interesting and immediate violent reaction by the market. Some asset classes moving higher on a weaker dollar, other asset classes moving much lower on a weaker dollar. But before I go into some of the details here, I just wanted to show you here on the S&P 500 futures, the market still is holding an uptrend, but again, we are entering an area where the markets have just had a very difficult time punching through. If we look at the volume over price on this screen here, I like looking at both volume over time and volume over price, and volume over price is right here. You can see all this volume in this area here, which is not surprising because we've been stuck in this area since the beginning of April. But if you really want to, truth be told, we've been stuck in a wider range for over a year, maybe a little bit longer than a year time frame. You can also see that every time we get up in this top portion here, anywhere over 2100 into our all-time highs of 2134, and again, this is in the S&P 500 E-mini futures, that we always, for the past year and a half or year or so, have pulled back. And there's just all this bulls versus bears battle going on right here. And you know, down in this area down here, the bulls are winning and pushing higher, but up in this area up here, the bears are winning and providing a lot of overhead resistance to any further upward movement. If we step out and we look at this on a weekly basis, just to give you a little bit better perspective of what we've done here. Looking at this chart, now I've got two Fibonacci series overlaid on this chart. I'll explain them in a minute, but you can see here that outside of 2011, which was right there, okay, that's 2011 in that box right there. You can see we entered the year right in that area there. We finished the year right in that area there. So we finished a little bit lower for the year, but not without a pretty good little drop, okay? But outside of that year, since March 9th, I believe, of 2009, or March 6, 2009, we've been in a very strong uptrend. A lot of it precipitated by a overly eager central bank, not only in the United States, but then later followed by Europe and Japan and China and Great Britain. But you can see that since the summer of 2015, and if we were to take it back even further, let's go back to 2014 right there. Once we entered 2014, we continued the upward track, right? And then we hit the all-time highs in the futures and the E-minis at roughly 2134 right here in the summer, May, about the third week in May, around May 20th of 2015. And almost a year to that date, maybe a little bit later, we're in June now. But this past week, we're trying to reach up here, and we just cannot seem to penetrate above this level right here. Every time we get up here, we get a little bit of a pushback. And right now, we will break this level. Now, I don't know if we're going to break up here or down here. A lot of money is betting that we're going to break to the downside, which is probably why the markets have been so entertained to the upside. That's kind of where the markets seem to enjoy going, because the markets always go where nobody expects it to go. But this is kind of where we're sitting right now at this moment. But we're going to break one or the other. Now, just as a reminder, we've got the Feds coming up on the 14th and June 14th, 15th time frame. And this dismal job reading this past Friday, it was a 21 to 25% chance of a rate hike in June. Now that's dropped back down to 4% again. And the July rate hike, which was almost 50%, has dropped back down into the 20s. So now the markets are transitioning back to to a softer Fed because, again, there is no fear that the Feds are going to raise the rates given this one report. Now, the Feds have always said they don't look at any one report in context of the overall market environment. And leading up to this report on Friday, the Feds have been saying for the past 3 weeks that they could see 2 rate hikes this year and at least 1 in the coming months. So I'm not entirely convinced yet that we're not going to still have 25 basis points in the next, possibly not this next week, but in July or August timeframe, right in the middle of the summer when it's quieter. So this is kind of the range, though, that we've been in, and we're looking to break this range here. Now, the only thing that is good on this chart here, you can see I've got the weekly Fibonacci's on here like this, and a natural fib pullback zone takes us down to this area right here over this long time frame, which is happens to be the prior pivot highs from the dot-com bubble in 2007. So I believe my take right now on the charts and what I'm seeing in price action is that by the end of 2017, we're going to get our 20+% pullback. And the likely area is going to be somewhere in here south of 1700. Now, pick anything that could be the trigger. It could be China's debt bubble. It could be Japan. It could be the Feds. It could be ECB in Europe. I mean, it could be anything, right? So I'm not really trying to pick the cause. I'm just looking at the effect of where the price action is right now. And you can see since that we've entered this area right here, it has been extremely violent. Once we started these pullbacks, we've had up, down, down, up, down, up, down, up. I mean, that's just, we're playing in both extremes right here. So it's kept volatility a little bit higher than what we were used to in 2015, but overall volatility is still relatively low. And Friday's job numbers, as bad as they were, volatility never really went screaming higher, and we're still in a contango environment in the volatility futures, which means we're not in a backwardation, which means the markets just aren't that concerned right now. And perhaps they're not because they just viewed that this Fed, at least through the election of the end of this year, is very soft, very dovish, and they're going to always be willing to step in and provide more stimulus should the markets continue to, show up a sign of rolling over. So there's just not fear out there in the markets right now. You can see if we come in and look at the daily again, I'll show you here on this daily chart the fib nodes that I have in here. And looking at this, you can see right in this area right here on the daily chart, this has been a common resting point here, the 23.6%, right in that area there. Now, if I were to extend it over like that, you can see that it's provided support, a little bit of resistance here, and then a lot of support right here. Just keeping the markets in check there, right around 2032. In fact, this was the prior neckline of a prior head and shoulders pattern until that came unglued. And that head and shoulders pattern then did not fire off. And so this can be a sticking point. Should we take out 2032? Let's say the markets start getting weaker and concerned that the markets are slowing down, and the Feds come out and they're a little bit more hawkish, although they don't raise the rates, but they appear more hawkish. This is going to be a near-term line in the sand for us, around 2032. Should this break, you can see the 50% or the 38% node, just like that, which is where the next potential stop area is. You can see the support here, the resistance here, generally a little bit of a support in that range there. So this is kind of what we're looking at, what I'm looking at right now, 2032 and then 1988. Now this is on a daily chart, guys. So that's kind of what I'm looking at. Now if I zoom in even a little bit tighter on this, staying on the daily chart, okay, let's just zoom in a little bit more and give you guys a little bit better perspective here. On this daily chart, as I was telling our members at the beginning of the day, I said, we could edge up a little bit higher. In fact, my chart was calling for I'm sorry, let me just take that off. My chart was saying that a possible upside would be right in this area here, right around 2116. However, we had a conflicting view with a possible bearish divergence. It has not triggered yet, okay? We haven't had a cross in the MACD. But should it trigger, we did make a higher high there by just a point or so. That would suggest a possible rollover to at least test the 50 EMA here. Around 2060. So we've got some conflicting signals. I do believe that the bigger risk or the bigger move risk clearly is to the downside. The upside is more of one of these grind higher kind of things. And I think the markets are going to be steady as she goes, even with that move. If we on Friday, if we look at the 15-minute chart on Friday, just to show you an intraday view, you can see here that big move once we got the report. Okay, this first big down bar was at 8:30 in the morning. That bar right there. And then the price action tried to come down, move up, you know, kind of had one of these bear flags, and then boom, away we went. Then we made our low right around 10 or so in the morning, and then we just spent the rest of the day making higher highs, and higher lows, going right into close. So we made up a lot of that big drop that we saw going into the 8:30 8:30 jobs report. So this tells me that the market still wants to grind higher if possible. And short of any really bad news coming out of the Feds, the markets are just assuming Janet Yellen is going to do what Janet Yellen's going to do. Now, as I said at the very beginning, there are a couple of asset classes that tend to do better and others that tend to do worse when you get this kind of market movement. The first one that I wanted to show you is the bond market. The bonds just exploded higher. And as I've told our members, we've been in this trading range in the bonds for quite some time, right in that area right there. And you can see that up in this area here, then bond shorts like to jump in and push it back down. And then when we get down in this area down here, then, you know, bond longs want to come in and push it back up. So we're stuck in this range. We are going to break one of these areas here. The risk of a bigger move, quite frankly, right now is probably to the upside. It's kind of changed over. Remember, this is the 30-year bond, and the 30-year bond is more susceptible to inflation than it is to near-term interest rate moves. And that jobs report just basically said there is no inflation, there's nothing out there. The shorter end of the yield curve, the 2-year, the 5-year, the 10-year notes, they're more susceptible to what the Feds are going to do in interest rates. And they also moved higher too, which meant the interest rates moved much, much lower. We're playing these trades here, and I still believe that over a longer term, we're going to gradually move lower. It's just going to take some duration to make that trade work out. So the other thing is when you start getting near all-time highs in the equity market, just 30 points away or so, and you start getting near all-time highs to the bond market at the same time, you've got a really crazy correlated market. It shows that there's no inflation expectations, there's very low interest rates, and the markets are just not afraid. Even with earnings coming in as poorly as they did in Q1 of this year. And that's because of all the stimulus that's floating around out there. So with the bond market, I think there's going to be some great trades in the bond market. And that's kind of what we're looking at right now. If we look at the currency market, look at what the dollar did on Friday. The minute that report came out, I mean, it just, you can see it was in a nice little uptrend based on all the jawboning that the US Feds were doing, saying, hey, it's time for a rate hike. And then all of a sudden we got that jobs report out, And even though the Feds didn't say a word, they just now making the assumption, the market price action, that the Feds are between a rock and a hard place and they're not going to raise the rates. If they come out and they're more hawkish, I guarantee you the dollar's going to reverse and go right back up again. So you have to be careful on that. But Janet Yellen, the markets are betting that Yellen is going to be, well, Yellen. And she's going to be yelling for dovish behavior, which would tend to put the dollar back in this wider zone here until she has to act. But that's kind of what we're looking at the U.S. dollar level. And then obviously the yen, all the other currencies moved strong against the dollar. You could see just the yen moving up here. Now, we're going to look for a trade in the yen. I've been talking about the yen for a while, and I think there'll be a really interesting trade in the yen coming up. We've also got a trade in the British pound. You can see the British pound here. They've got a key event coming up on June 23rd when they vote whether the Great Britain stays in the European Union or they exit. And we got a great trade that I think may be very interesting leading up to that vote. Gold, well, low interest rates, low inflation, gold soars. I mean, look at what gold did. Gold just flew. I mean, I had said gold would come down to around 1,200. It came below on a daily basis. It closed back up above. I think the lowest close was around 1214, but it got down to about 1198 intraday on the 31st of May. But you could see that support area right here that we're sitting in. Now, should we get gold move up, let's say like this, and then start to get weak and come back down again, then we got the makings of a head and shoulder pattern, right? That being the left shoulder, this being the head, and this being the right shoulder. So I don't know if that pattern is going to play out because we got to see where the price action is going to go right here. But that's what I will be watching for. A similar thing that had happened in the E-minis, which did not play out because the E-minis just took off. I forgot to show you guys, but if you look at the E-mini chart right here, you can see right in this area here, we had the neckline like that. That was roughly the neckline. And then we had the left shoulder, the head, the right shoulder, and then we just tested that intraday. We never did break it by the end of the day, and then we shot off, took out the prior pivot high here, which is now providing a little bit of support around the 2080 area. So that left shoulder, head, right here, right shoulder, did not play out. So that pattern is null and void, and now we're playing this pattern right here. And as I told you, up in this area here is going to be very rough going, which means we could be, I would be more interested in selling calls up above the current price than selling puts underneath. Not unless you go way out in time and buy some duration where you can adjust it a little bit easier, okay? Now, the other one we had talked about was we talked interest rates, we talked currencies, we talked metals. If we look at oil, OPEC, as usual, came out and said and did nothing. So oil is near the 2016 highs. But I do believe oil is reaching an apex for 2016. I don't think it's going to go much beyond, if at all, 53.60 area, which is a natural price resistance level, and then I can see that pulling back. Soybeans, we've done many successful trades in soybeans. We made new 2016 highs on Friday, but we still got a really great trade in soybeans. I would be more apt to sell calls up in this area. In fact, we'll look at that coming on Monday of this coming week. All right, everybody, that's just a quick roundup of what we got for the markets this week. Really interesting price action across multiple asset classes. In the next 2 weeks, the month of June, as I said, is going to be very interesting. We got the Bank of Japan meeting and what they're doing with their stimulus. We've got the ECB, which said they're not doing anything right now. And then we've got what all eyes will be on is Yellen. And let's see what she does. And she's got a press conference because it's a quarter in. And then we got Great Britain coming up after that the next week on June 23rd when they vote whether they stay in or stay out. So a lot of really interesting opportunities for us from a trading perspective. For those of you that are not members, I highly encourage you to come in and check us out. check the offer that we got. We got a lot of people coming in. We've got a good start this year, or halfway through the year. I suspect the latter half of the year is also going to be great for us. So come on in. Love to have you come in and work with us. All right, everybody, have a really great weekend and good beginnings to the summer months for those of you in the Western Hemisphere, and I will see you guys later. Ciao, everyone.